infrastructure gap. The previous panel was talking about the gap. I think it's not a niche market, it's not a luxury. The demand is here, whether for local markets or for exports. The business models are very different, are complementary. So today I think the question is, how can we finance these projects? And I think there are the main issues that we'll go through are risk perception, regulatory frameworks, regional integration. We are in Africa, we have a fragmented market, and also the business models might be different from what you see in other countries, like the ones that Emi spoke about, like export markets. How can we finance that? So we will have 3 panelists today. I'm happy to have Tolu with me. She's Managing Director of Argentil Capital Partners UK. She's bringing expertise in structuring capital and debt financing for digital and overall infra projects, but she has strong expertise with digital infrastructure. Matija Jekovec, sorry if I pronounce it correctly.
Hi, thank you.
So he's the CEO of DHH. He has a strong track record actually in scaling and consolidating infrastructure across emerging markets, mainly Eastern Europe, as I understand. But
yes, Southeastern Europe, yes.
And you will tell us more about DHH as part of your first question. And Dr. Ayo Tunde, hopefully connecting soon. He's the CEO of Open Access Data Centers, OADC, and he's joining us remotely. And he operates one of the continent's platforms already active in 2 or 3 countries, I guess, Nigeria and DRC, and he will tell us more about it. So hopefully we can connect him now. Otherwise, we can start with the colleagues present here. No worries. Then we can start. We will have more time for questions, I guess. So Tolu, I will start with you directly. So, I mean, I saw we spoke, drawing from your experience, I mean, structuring data center or major infrastructure projects. What do you think is fundamentally different about financing digital infrastructure in Africa versus more mature markets or more developed markets? Do you think that the risk perception is aligned with reality? What are the key differences that you see when it comes to financing of digital infra?
Thank you, Ahmed, and thank you all. So just a bit of intro before I go into the response, just to speak about what we do. So I represent Argentil Capital UK, and we are a financial advisor based in the UK. And we raise capital and support companies and project sponsors in raising capital for digital infrastructure projects. So that's really our focus. We work exclusively within the African continent, and we have done this for a number of years, and we're keen to have further discussions following the session. So just to come back to your question, Ahmed, around how financing looks different within the continent versus elsewhere and the risks. I would say that the primary difference or the primary consideration is really around the levers of demand. So I'll start off with hyperscale data centers and how these are funded elsewhere in the world, in Europe and the US. So typically what you would have is that the financing for data centers, particularly the larger hyperscale data centers, is anchored by long-term contracts between the hyperscalers and the developers. So you have contracts, on average 15-year contracts, with an extension option for say another 5 years, 10 years, and in certain very positive cases, you have an additional 15-year extension option. So when you look at that sort of contract, you're looking at easily a 30-year contract backed by cash flows from a hyperscaler. I mean, just by describing that, you can see how commercial lenders, investors will be very, very keen to get behind those sorts of projects. Now, coming back to Africa, I mean, we have much more limited hyperscale presence on the continent, so that's, that sort of structure is not even readily available to us within the emerging markets. Now, to bring the conversation to co-location data centers, enterprise data centers, and increasingly now edge data centers, AI data centers, and I think this is probably even more relevant to the room, the demand conversation is still very, very critical. Investors would not put their money into a potential opportunity if there isn't demonstrable and clear demand for uptake for the capacity, right? So, I mean, over the course of today, we've talked about demand drivers, the rapid population growth across the continent, and how that's going to drive enterprise growth. With, of course, AI, the conversation around AI is very hot, and how that's, again, going to potentially explode across the continent positively. We also, again, there's the concerns around latency. So when you don't have your data centers within your in-country, you have to deal with latency issues and so on. I mean, these are all demand drivers, and the reason why we're all in the room is because we believe in that future. In order to get financing in, we have to be able to translate that demand into hard numbers, hard evidence that would then drive the inflow. Frankly speaking, hardly ever would you find an investment other than, say, a concessionary finance investment where the market isn't clear and the demand for the services isn't clear. And I think that's what we've really struggled with as a continent for multiple reasons. And to come to your second point on risk, again, this ties into the conversation about making a case very clearly for in-country, in-continent capacity and infrastructure. The risks are, we've talked about demand, but very often we don't like to face the realities when it comes to the risks, right? We have concerns around the macroeconomic situation in countries across Africa, some countries more than others. We also have, there's concerns around currency convertibility, taking out capital once it's gone into a country. These are all really valid concerns. And what I like to say is, do not shy away from those risks. Let's be very honest with ourselves. And once we have the conversation, we identify it, and we address them, then we're ready to go into the market to grow the digital infrastructure on the continent.
Thank you very much. That was very helpful. So actually what I noted, cash flow is king, coming from also DFI perspective. I think the idea is to translate that demand into hard numbers and facts to be able to explain it to lenders and investors. And second, do not shy away from risks. Be upfront about them and think about mitigation. We can speak about the instruments later, but that was very helpful. Thank you very much. Matija, I think, but you can tell us more about DHH. You've built a successful regional platform across Eastern Europe, perhaps touching some of the Mediterranean countries. Can you tell us, from your experience, from these acquisitions that you've done, what could work, what can we translate from that experience into Africa, and what wouldn't absolutely work at all? I think the room here wants to read and to listen to your experience on that.
Yes. First of all, thank you for the invitation, and it's really interesting attending this event after 2 years now. Also to see, let's say, the growth that happened in the last 2 years. My perspective is more of an outsider perspective, because we haven't done an investment in Africa. Regarding DHH, I'll have my talk after this one, so I will go into detail. But I would start, let's say, from a different point. And I would say that, at least for the last couple of years, also talking to Ziad, also talking to the chambers of commerce, to other colleagues that have invested in Africa, I think that there are, let's say, three major points that, or let's say three major risks that they usually highlight. And they are tied to, let's say, regulatory framework, the stability, and how this is, let's say, resolved. Then there is also the currency risk, which is also very important. But let's say the major thing that scares investors is, let's say, doing business in Africa. So because it is, let's say, so different. I mean, I will share my own perspective how different it was in different regions, countries in Europe. But for someone from Europe, it's so much different that you need, let's say, to have a leap of faith to actually start doing this. And let's say, I won't go into detail on, let's say, what we DHH do. We will do that later. But just a few points, because I was thinking about this. The way we do acquisitions, it's a bit different, because when we acquire a company, we actually require the founder to stay inside the company, and we treat them as collaborators. So they are people that we work with to actually develop to scale the company and so on. And I think that this approach may work well, because it's addressing more or less two of the concerns that I highlighted. Because we have the person, our person on ground that knows how to do the business, because we're looking for successful companies that are present in the geography, and we're very picky about, let's say, who we acquire. But in the end, we have a relationship that developed to the point where we can trust this person, and this person maybe it's a battery issue. No, yeah, okay. No, continue like this. Okay. This is actually the way we do things. We would. Let me make a change. Yeah, I think it's working. So I would bet that this approach would actually work, because we are both, let's say, in a way, we're shifting responsibility, but we're also sharing the risks. Now to the point about, let's say, the currency risks. We don't have a good solution for this. I don't think that anyone has, because we're mostly focused on small and medium enterprises that we're acquiring. So we're talking from a couple of 100,000 euros to a couple of million euros in revenue. The problem is that usually these companies are not large enough to warrant some, let's say, really expensive forward deals to buy currency. So we cannot rely on this. And I can only share, let's say, the way we do the acquisition, which might translate well to the African context. And we usually do it in multiple steps, or at least 2 steps. So the initial step is where we buy, let's say, a minority or a majority share, depending. And then in the second step, we actually just simply set the model. So we set the formula. Usually it's, let's say, multiples of EBITDA or something like that. And then after a couple of years, 2, 4, 5, depending, we buy the rest of the company. Now, why is this good in this context? This is a way to avoid the risk of buying a company for X, and then after a couple of years, the company is doing really well, but actually the exchange rate ate all the difference. So this way, we're actually protecting ourselves, but also, let's say, we're protecting the entrepreneur, because we're doing the valuation at step 2 for the rest of the company, which can be beneficial or, I mean, and detrimental. It depends on the outcome, but actually we're sharing risks. So I think that this would be approaches that would work well. What wouldn't work well, and I'm pretty sure about this, is if we come in storming, telling everybody that we know exactly how things are done, let's say deploying our own products on the same markets that, let's say, believing that the markets are the same as in Europe, and then just waiting what will happen. Because we had experience in doing this, transferring this from, let's say, Italy to other markets in Eastern Europe, and we failed. And I'm pretty sure that the difference here would be even bigger. So not understanding the local market, pushing products that work well in the Western Europe, this would be actually a big error in judgment and execution.
Okay, thank you very much. That's an interesting business model, actually. You spoke about the risks, regulatory, currency, and especially doing business and how to develop your data center business in Africa, which is very different from between Eastern Europe, Western Europe, and Africa. You've built a model, and you have a separate session about how you manage the acquisitions through a phased approach investments. And I think in a second question, we'll come to it. I'm curious to understand what are the success criteria now that you have companies in your portfolio after 3 or 4 years of investments. What are the 3 or 4 criteria that you think are key for any new investor in that sense? But let's keep it that to the next question. let's see somehow the audience.
And just before you ask the next question, I just want to piggyback on the point you made about the ease of doing business. And it's always good to get a fresh perspective from, well, for lack of a better word, from an outsider, from someone looking in, right? So, I mean, the discussion around ease of doing business across Africa has always been a concern. It's always been a hindrance, you know. And the interesting thing is, if you look at the actual ease of doing business ranking and the elements that go into that, in certain cases, it's really, really little things, like visa restrictions, for example, even within Africa. And if you think about it, really, if there's constraints for a non-African to come into an African country, something as simple as a visa is enough to put off investment, right? There's a long list of items there, and so many of them can be easily remedied just to, you know, decrease those barriers to investment. I know that there's quite a lot of work around intra-Africa trade and intra-Africa movements. I'm sure you're aware of the Africa Trade Association. Yeah. You know, they have made a number of inroads, but there's still so much to be done, particularly for digital infrastructure. The focus so far has been for trade and movement of goods. And whilst that is absolutely essential across the continent, we need to start thinking ahead into digital infrastructure, you know, mobility of services, and so on.
So just to reflect on that these are very, very important points. Having worked with one of the leading DFIs in the region on this kind of doing business and ease of doing business, even if it seems small, there are a lot of work, what we call political economy. There are some here and there interests that need to be aligned, and it takes time. And that's how it's done. When it comes to understanding and also ease of doing business, I think one of the things that you need to look at is the value of partnerships. Partnering with investors or operators or companies that know the market, that have already invested, that they've done their job, so they can partner with other players because the risk is there, but how to mitigate it, and I think the value of partnerships can be one part of the answer. So Tolu, let me get into follow on what you've said about the risks. You know, we talked about DFIs. I think we hear a lot about blended finance, grants, and de-risking instruments. Don't you think we're somehow over-relying on these kind of concessional financing? What needs to be done to move to commercial financing? Are we there? What do you think we are missing? What's your kind of view on this?
So I'll just jump right into the answer, right? Just off the bat, and I'll explain. I don't think we're quite there yet for digital infrastructure in terms of concessionary finance. And I think just for the benefit of the room, when we talk about concessionary finance and blended finance, this is a category of capital that is provided to a project that is typically deemed as a high-risk project, right? So once you have that concessionary capital come into the project mix, then that would enable commercial lenders to come in and participate as well. And another benefit also is that if there were to be any losses on the project, the blended finance aspect would take the first loss within the portfolio, within the project. Now, blended finance is not new. Concessionary finance is not new. However, understandably, it hasn't featured materially within digital infrastructure on the continent. There have been pockets of investments, and I mean, it would have been great to hear from Dr. Ayo, because I know he's very active in that space in Nigeria and across the continent. For concessionary finance to really be qualified to have worked within a specific sector, that sector needs to then have ridden the wave and can then stand on its own and doesn't need that concessionary finance. Because if you look at the nature of financing for projects, the final position in what I would call a financing spectrum is when commercial lenders, private investors are happy to invest in your business. We're not quite there yet in digital infra. We're only just starting. So I would say at the moment, the more concessionary finance we can get to get us going, the better. Now, I do hear your point, and we have seen sectors where there has become an over-reliance on these sorts of financing, and really, that's in the long run, that's not beneficial for the sector, right? Because ultimately, you want it to be fully deregulated, fully commercial. And I think still on the point of blended finance and similar structures, so far across the continent, we have seen this sort of investment mostly coming from international development finance institutions. We haven't quite seen that we haven't quite benefited from those sorts of capital sources from in-country, rather in-continent, so the African DFIs, right? And I think just to pull this together, if we're really talking about growing the continent's digital infrastructure, building internal capacity, conversations around data sovereignty require the continent to have the infrastructure on ground. Then, for financing, why is it any different? The local development finance banks should be participating. And we as Argentil are doing a lot of work with them, because the reality is a number of those DFIs have not done any digital infrastructure transaction. So for them, it's also a learning curve for them to understand how it works, and then ultimately participate in growing the business, growing the sector. What I like to say, and what I tell them when we have the conversations, is you need to think about digital infrastructure and think about it the way you think of roads, the way you think of rail. Just because you can't touch it, which you can, because we know it's brick and mortar, it's as fundamental as roads and rail to unlocking the continent's fourth industrial revolution. So lots of work going on in that space, and hopefully we can change that trajectory over the course of the next few months to years.
Thank you very much. That's a very nice call. So we need concessional finance. That's like almost a given. And what you're calling is, even with DFIs, the pockets available for digital infrastructure blended finance is not there yet. And beyond traditional DFIs, there is a case that needs to be built within sovereign wealth funds or sovereign development, the local development banks or investment arms of the government that would support at least that part of getting off the ground of the data centers. That's interesting perspective. Thank you very much. Matija, I think the last question for you is, you spoke about the acquisitions. I'm curious to see, but first question is, you're acquiring existing companies, so they've already financed their initial operations, let's say the greenfield part. How did it happen in Eastern Europe or in the regions you're covering? I think we're curious to understand that. And second, what are the 3 or 4 success criteria that you think are very helpful, so for new operators that they should focus on these kind of criteria up front?
Yeah, first of all, all of the acquisitions that we made so far are companies that were bootstrapped. So we're talking typical, let's say, entrepreneurs that started in a garage or in a small office or at home and so on, build their business without external investors or, let's say, with the funds of family and friends, and then managed to scale the company to a certain size that became interesting to us. So, probably the advantage here is that these companies are more or less all relying on subscriptions, on recurring revenue. And that's why also DHH is very, let's say, producing a lot of cash, and let's say we don't have problems in this regard. And this type of business is actually slower to get off the ground, but once the ball is rolling, it's much easier to scale. So more or less, these were all of the companies that we acquired had this, let's say, has this type of operation. Regarding, let's say, the key success factors when we are looking at a company like this, there are a few things that are really important to us. So one of it I already mentioned. So they are subscription businesses, they have recurring revenue, and this point on recurring revenue is very important to us. The second one is, let's say, how agile they are in developing new products. So how frequently they release new products. What is the part of the revenue that is actually coming from new products? Are they, let's say, what type of technology they're using? So this, let's say, product space is really important to us. The next thing is, let's say, how well they are able to present their numbers. So, for example, with smaller companies, you have this typical, I would say, excuse where they say, okay, you look at the balance sheet and say, what is this? And they say, this is, let's say, this is not something that is real, so we'll take this out when you do the valuation and so on. And you have a lot of items on that balance sheet that work in this way. So they are not, I wouldn't say that they're optimized for being sold, but they are not even optimized in the basic sense because, let's say, the primary concern is how to reduce the profit, not to pay too much taxes, which is actually counterproductive when you're talking to an investor. But let's say the overarching factor of success that we're actually focused on is actually personal due diligence. So for us, more or less the due diligence process, looking at the numbers, asking the questions and so on, is just an excuse to get to know the founder. Because when you present the founder, the entrepreneur with some questions, especially the hard ones, so let's say where you find something that looks like it was hidden, but maybe it wasn't. When you look at something that might be problematic or you see as problematic, and you confront the person on the other side, and you see their reaction, you see how they perceive this, you see how they react to this, you see how they are, let's say, willing to constructively discuss this or, let's say, become defensive. This is actually the real due diligence that we're doing, because we know that this is the person that we will be working with long term, and this is actually the key factor of success for us. So what kind of person is on the other side?
Interesting. So people, but then also cash flow generation, agility in product development, and financial discipline, but people first, and then
yes.
It's
I
very
would say that all the rest is a required condition to actually start discussing, and the personal due diligence is the one that actually brings everything across the finish line.
And one just quick follow-on question before we let you the floor. What do you think of the hybrid business model? I don't know, it's a difficult question, so sorry for this, but a hybrid business model where you have a data center that is based in the region, that is connected to Europe to serve international clients. What do you think of that? Have you thought about it? What are, in your view, what are the key risk areas that would need to be addressed to have such a successful business model? Because what was said in the previous panel, this kind of a new business model that is also, but it's a very strong opportunity for data centers that are based, at least in North Africa. We see this growing interest. So what's your view from a European perspective on having this, let's say, hybrid business model?
I would say that it's an opportunity, but it can also be a trap. Why? I mean, opportunity, let's say from the top of my mind, I would say that the opportunity is there because there's a cost arbitrage. So we can do, let's say if I say we in Europe, can outsource the parts that can be done much cheaper and get, let's say, the cheaper service that we can do in Europe. This is an opportunity because, let's say, European company can therefore generate bigger profits. The business can also be, let's say, for a Tunisian company or something like this. Why am I saying a trap? I would say that the problem here is, and I think that we opened this topic also with you, Tolu, before, the problem is where are the margins? So if the margins are with the European or US or Chinese company and so on, and you're only getting let's say, the payment or the margin on the services that are, let's say, lower on the value chain, then it's like, I don't know, extracting natural resources. So you're actually selling off the thing with a lower margin, and then you're buying back the things that are higher margin. Does that make sense? I think we should be, but it's not. I'm not saying it's a bad idea. I'm saying it's a good idea if you have a strategy. So you start with this, and then you build on this, and don't stop. This is the point I want to make.
Perhaps you have a follow-on before we give the floor to Q&A.
Just to follow, and I have a lot to say generally. I think to that point, I think one other concern that may be an issue, and you're probably best placed to check if it's a concern, is really around the regulations around data as well. So data stored on, so there are regulations as to where data can be stored. So if you were to be a European company storing your data in, a data center located in Africa, there has to be a discussion around what the regulations are in that country and how it syncs into, the regulation in the counter country. I guess in this case would be GDPR, So I guess that's another consideration. But I know that we have loads of people in the room that are better placed to do that. But I just thought to make that point as well.
Yeah, definitely. I mean, this is also an issue. But I mean, this can actually be an opportunity because, let's say, making a data center that is compliant with GDPR, and if this requires also the change of local regulatory framework to be compatible with this can be a win-win for everyone. But it's not off the bat. It's not something that you can do right now with, let's say, 3 simple steps.
Thank you very much. Let's open the floor if we have questions. Questions can be in French. I will help with the translation if needed. Any? Becky, of course.
Hi, thank you so much. So I'm Becky and co-founder at SolarCrypt. Really interesting discussion, thank you. My question is, for data center developers, what is the most appropriate point in that development life cycle to get financing partners involved? And that could be yourselves, but also...
I mean, there are a number of factors, and I think we have started to talk about a few of them before this session. But I would say the creditworthiness of the off-taker, I think, is really, really key. We look at, well, not we, I mean, as an advisor, would look at, on behalf of my client, I would look at things like the nature of the lease, the situation around the land, freehold or leasehold, all those sorts of things. Of course, the EPC contract, all the regular stuff that goes into assessing a project. But for financing, I would say the most critical one is the creditworthiness of either the sole off-taker or your target, sort of customers and customer base, because ultimately that's where the repayments come from. So yeah, hope that helps.
Any other question? I saw someone raising their hands earlier. No? Okay, well, with that, thank you very much. And hope to see you next year also. Thank you very much.
Thank you.